Welcome to Markets Now. I'm Michelle Rourke with Mike Miner, professional ag marketing, on an update in everything except for the wheat market. And Mike, let's talk about kind of the complex in general was higher commodity-wide buying. Where did that come from, do you think?
A lot of oversold conditions across the board, whether you're looking at corn or soybeans or the hog market, for example. We've had massively oversold technical conditions. So, a little bit of technical buying today, I think, across the board for a lot of these commodities. And we put together a nice little rally. I think the follow through will be really the most important part on this because we'll get a few of these days here and there, especially with the funds being net short record positions on corn and soybeans. And even now on the hog market, for example, we are developing a little bit of a short there. So at this point, we could see some days of short covering like this or profit taking, but to sustain it for a while is going to be incredibly difficult, Michelle.
Do you think the corn and soybean market tried to put any risk premium in at all here with the derecho event that we saw Monday night or not?
I really don't think so at this point. The tough part about that derecho, it was a smaller pocket. If you look at that eastern Iowa and a lot of that north and western part of Illinois where it really hit hard, a lot of those areas are still looking at potential record crops. And, on the Iowa side, especially, it just wasn't quite severe enough for them to even lose power in a lot of areas. And it did hit some spots pretty hard, destroyed grain bins and all of those things as well. But for the whole US, condition scores being where they're at, the drought map being where they're at, it's going to be difficult for the market to react to one in particular weather event, I think, until we can really assess how big the damage was in that area.
Yeah, it just doesn't feel like we have a whole lot of weather or risk premium in these markets, Mike. And, the funds keep pushing the short side. How long do they effectively keep doing that if they're near to record short?
Yeah, at corn, soybeans, record shorts. If you combine the three, corn, wheat, and soybeans, you're at a record short for those three. History would say not long. You wouldn't hold that short position for some time. The problem will be that we've got 3 billion bushels of corn sitting on farms' hands as of the quarterly stocks report in June. And any rally, any short covering event that we will have occur on these grain markets, especially corn, we're going to have a lot of farmers selling for old crop against it, as well as new crop as well. We not a fantastically large book for new crop yet, so that farmer selling is going to limit any potential rallies, especially at first, and that's going to limit things for a while. So the balance sheet just in general is going to have to come off their 181 yield if we want to get things too excited about some short covering rallies. Because at this point, if you look at analog years back in like 2014 or 2009, we can still take a lot off of these grain markets until about the end of September, beginning of October would be that kind of that seasonal low in those analog years, I think, when looking at it. So those are a few things I'll be focused on pretty largely going forward into as we kind of wrap up summer and kind of look towards the beginning of harvest.
Mm. So in corn and soybeans, from a technical standpoint, $4 is held so far in December corn. Will it continue to hold in kind of what are you watching for the line in the sand here for soybeans?
Well, when it comes to the line in the sand at $4 for corn, you've got a pretty strong support area there, 398, 393. That seems to be holding. Even if you look, the option premium below $4 is pretty cheap yet for put options. So when I kind of look at what the market in general is thinking at this point, is some pretty cheap protection down there. So they're hoping for some cheaper support there around $4. And we're really going to try to figure out how much inflation matters to these grain markets as well. Because with a 14+% stocks to use ratio historically, December corn of 2024 should probably be below $4 historically with that type of carry out. So if we could get the balance sheet to tighten up just a little bit with some of these adverse weather concerns throughout the corn belt, we could miss some key rains in the east that really help give us some support around $4 here. And The other aspect too is how far the fund's going to push it, right? Since they
Right.
already have a record short, maybe it's going to be tough for us to go down much larger unless the farmer really pushes us towards that, mid threes. But on the soybean side, I think they could do some more damage yet. But I think the two of them are pretty similar. The soybeans have a little bit better premium based on the ratio compared to corn. We've been hovering around that like 2.65, that soybeans are 2.65 times greater than corn. So a little bit more premium in the soybeans, but we're trying to kind of fix that this week. Prior to today, at least it looked like, Michelle.
Yeah, and we did score a new contract low here this morning, down right
Mhm.
in around that 1037 area before bouncing. But unlike corn, the demands picture is not very good for soybeans, right?
Yeah, I mean, ethanol, you've had very improved margins recently. Export activity was running ahead of pace, and now we adjusted exports up quite a bit in this last WASD report. Soybeans, kind of the flip side of that. The NOPA crush
Hmm.
report wasn't fantastic here. Soybeans have been running slightly below the needed pace for the USDA expectations. I think a big question mark going forward will be, are we getting cheap enough to stimulate demand in corn and soybeans? Not yet, it looks like. Wheat, we probably did a little bit. The WASD report didn't help us last week in wheat, but it does look like we're at least getting cheap enough to start some demand there. And corn now, too, you're starting to see it a little bit. But the outlook going forward, I mean, even when we start talking about what happened to Trump this week and the odds of him getting reelected going up, those types of things are going to impact China as a buyer. Are they going to start stepping in as some bargain buyers before harvest here, before the election, just in case he does get elected and they've got some harder trade concerns going forward? Maybe that could help put a little bit of a floor in these prices ahead of harvest. But if they feel comfortable, if Brazil ends up with their massive crop that they're harvesting very fast, maybe they're going to be a little bit more patient on the buyer side, Michelle.
Cattle market, we've been in a consolidation pattern here off the recent highs, but you have this big premium that the cash is holding to the futures. So the futures can't really fall too far. So what gives here? Or do we meet in the middle with the two?
Well, last week I was really concerned because we reached a point which looked like seasonally that choice had topped out, and once that had happened, I had became very concerned about Packer aggressiveness and how strong they're going to be in the cash market. And honestly, I figure that cash has held pretty well versus my expectations, so that's been a really good sign. I would have thought that they would have tried to work cash down a little bit lower to kind of where those futures are in August, because there's a massive discount going to the August futures from where cash is today. And the futures are betting that the Packer will win that battle and will decline here in price going forward, and that choice will continue to sell off. And I don't think it's to anyone's surprise that choice has probably peaked seasonally and will work lower. It just depends where the leverage falls going forward. And at this point, I really contribute it all to we've had really high choice prices still relative to production. We've produced a lot of choice meat, more than last year at this point, and we've had a higher choice price now recently. So that was actually showing a very good demand sign recently for the cattle. So at this point now, I think going forward, it's just going to fall on who gains a leverage between the two. And I'm very impressed with where cash has stayed in the past probably week and a half here, I think, Michelle, for cattle.
Yeah. And the hog market, we'll wrap up with that. Some technical buying it looked like today, but we just put the new contract lows in the rear view mirror here. Can we build on this, do you think?
Well, it looks like we're seeing a little bit of better consumer demand at least here. Pork cutout values are a little bit higher, still not fantastic, but they picked up a little bit from the mid to low 90s where we were on the cutout values, and that was a good sign. We're going to look at this hog market as probably getting a short term bump from some short covering and things like that, some oversold technicals. I thought we had some technical buying going on today, and broad commodity buying in general, I think, is helping them out, especially with their big move in August today. in particular. But we'll see what that market does going forward. It's going to be very dependent upon where that cutout value falls. And at this point, we have already taken off a pretty good chunk of December futures further out. For example, that $7 came off pretty quick. So, maybe we could put some of that back on fairly quickly again if we get some positive fundamentals. Otherwise, there's not a whole lot changing in the meat fundamentals in general, I think, for what we see at this point, Michelle.
Thanks so much. That is Mike Miner with Professional Ag Marketing and Markets Now.